Hello, and welcome to the first video of what's going to be a series where we review kind of a full year of a fictitious person and learn some concepts of accounting, personal finance, and tax along the way. So let's dive in and meet our client. So today's lesson is about the basic accounting equation, and we are meeting Jenn Tze. So Jenn Tze is a lifeguard at the Strawberry Aquatic Center living in Vancouver. She really doesn't like her current job, so she's hoping to, in the future, maybe make a bit better of a situation, whether that's going back to school or thinking of more creative ways to earn money going forward. The current plan is for her to go back to school and get into a Master's of Counseling Psychology program either in 2026 or 2027. So we'll be starting by reviewing their 2025 year. And to do this, Jenn actually took some courses starting in January 2025 to kind of upgrade their current schooling so that they could get into the program down the road. All right, so in this lesson, we're going to be looking at Jenn's bank statement. So that's going to be just the starting point. We're going to look at January 2025, and we're going to go through each transaction and ask ourselves how this actually impacts the basic accounting equation, which is assets equals liabilities plus owner's equity. So let's move on over to the bank statement here. Okay, so this is sort of a dynamic statement I've set up where we can change the dates and it will populate the information we want. So this is pretty almost exactly the same of what a bank statement looks like. This bank is CIBF, which is Canadian Imperial Bank of Funk, and our client is Jenn Tze. So we're going to toggle for the dates of January. So let's just quickly take a quick little glance here. So Jenn started the year off with about 4.3 thousand in her bank account. And then here's all the transactions that happened. So there was withdrawals of about 14,000, deposits going in of about 15,000 for various things, and then an ending balance of 5,400. So this is pretty much exactly what your bank statement would look like in real life. And then I'm going to take us over here to this transaction page, which is the same transactions, but then a little bit of a note, right? Because obviously in real life, we need a little bit more context. So this is sort of me filling in the contextual details of what's happening so that we can actually go through and correctly categorize each of these transactions as we work through, right? So you can walk along with me. I've got a kind of screen snipping here, and I'm going to mark off each of these transactions as we go. And we're going to start off with the first opening balance. So how does this affect the accounting equation? Well, first of all, we have an asset, right? This entire bank statement is to do with cash. So obviously we'd expect there to be cash here, right? So cash should come in. And let's say our assets are increasing by that beginning amount of 4,380. But where is this else going to, right? So there's a few options here. Presumably, this is going to go to an account called equity, right? So the main difference kind of at the start you can think about is, okay, well, does this cash have to be paid back to somebody else? Or can it be yours for the taking, right? So in other words, if you had a loan of exactly this amount, you'd expect it to be under liability, but this is in your bank account. Presumably, this is Jenn's money. She can, this is for her to use. She doesn't have to pay that back to anybody else. So I think it makes most sense for us to put that into equity for now until we have more information. So that's good. The first one's done. Okay, second transaction, we see a withdrawal from the bank account for $400, right? So this pre-authorized debit. So what is this? It says Jenn read The Wealthy Barber and sets aside $400 a month for investment. So every single month, Jenn is putting money aside, right? So what does this happen? And the easiest way to think about this is, okay, well, obviously cash is being affected at the beginning. So we would very clearly see that minus $400 is coming out of our bank account. And where is it going, right? So this $400 is actually going to another asset, right? This transaction doesn't change any liability or owner's equity, but in fact, it increases our investment by $400, right? And we don't actually know how much the investment is currently at, right? That information is not given to us yet. Perhaps down the road, we'll be able to explore that a little deeper. So we can just put a question mark there because likely if Jenn has been putting this $400 aside for many times, like for a long time, then chances are she's accumulated some kind of investments over the long term. And that would also impact potentially the owner's equity, which we will dive into down the road. Okay, there's the first two. Okay, so now we have another withdrawal of 428. This says this is a strata fee for a Whistler investment property. So Jenn has a Whistler condo that she rents for monthly, right? So right here you can see she receives the rental fee of around $2,000. And this is rental income coming in from the investment property down the road. So how do we deal with this 428? Well, again, the easiest off the bat is obviously it affects the cash, but then what else does this impact, right? So is this a liability? Do we owe something? Not really, because we've already paid it, right? This is kind of a direct reduction to owner's equity. And let me add in these to kind of see what's happening here. Let's just kind of have our broad stroke categories of equity plus income and expense, right? So this is really an expense. This is an expense that goes up, right? This increases our expenses, which decreases our owner's equity, right? Because say we have this rental property of it's generating income each month, around $2,000, but we have some expenses associated to that. So we should try to track them separately here. So we're going to say, okay, this increases our expenses right there. All right, next one, we've got a $10,000 deposit, and this seems to be so this is related to Student Aid BC. So this is student loans actually coming in, whereas some of it, 2,500, doesn't need to be repaid, but some of it does need to be repaid, right? So we have 7,500 is student debt. So let's kind of add this information in here. Cash goes up by 10,000. And okay, so 7,500 of it has to be paid back. So it makes sense to think of our liabilities are increasing by 7,500. But what about that 2,500, right? That 2,500 in grants, this doesn't need to be paid back, right? That same concept of the owner's equity, we can kind of add that in, and we can almost think of this as income. And down the road, I'm going to introduce a kind of a different way of recording these into journal entries using debits and credits. But you can kind of think of this as like a secondary source of income, right? This is grant income that Jenn received for the month or the quarter, whatever it might be, and doesn't have to pay this back. So at the end of the day, this would increase our owner's equity. So remember, any income would increase equity and any expense would decrease it. And this is kind of like our opening amounts here. So that's good. This holds true. Assets equals liabilities plus owner's equity. So that's good. Okay, now we have rent, right? So we are paying rent ourselves. We are e-transferring someone. 1950 for rent. And it says here, Jenn rents a 2-bedroom apartment in Coquitlam. So, okay, cash is going down. And again, this is kind of, you can think about as an expense. So it's not a liability because we've paid it, right? It would be a liability if you're owing it to someone, but we don't have to worry about any liability here. So this is going to be another expense. This is kind of like Jenn's rental expense. It's personal rent, but I think it's still good for us to kind of differentiate between income and expenses. We can split between kind of personal and business down the road, but for now, we'll kind of bake everything into these categories. So cash down, expenses up. So that's good. Okay, now we have the rental income of 2,070. So this will be cash coming in of 2070. And this is actually going to be income again, right? This is now like our rental income for the month. We've got our grant, we've got our rental. So this will be another increase to owner's equity. Moving on, we've got a payroll. So this is now Jenn's job of being a lifeguard, who's receiving, and this is the net amount, right? In reality, there's going to be some payroll taxes and things deducted off this, and the gross would be different. Now, it's something that we'll be exploring in a future lesson, but for now, we can just think about this as this is the exact amount that goes into your bank account, your auto deposit, right? So 1608. Let's add that one in. And this is also kind of like income, right? This is like employment income, right? Now we have three sources of income so far. We've got the, different types. So we'll add that in. Income, we don't have to pay this back. Definitely not a liability. And sorry, let me fill in that. It was a student loan there. Okay, next one, we've got a transfer. Okay, so we paid 2,500. It says a credit card payment. Okay, so we're paying down a credit card. So this is just the bank statement. So Jenn also has a separate credit card statement. We're not going to be looking at that in detail today, but next time we will be. But this is like a payment. So presumably Jenn spent around, let's say, thereabouts around this on her credit card so far in January. Probably spent a lot of things. We don't really know what yet, but now this is like a paying off, right? So you're transferring money from your bank account to pay down your credit card. And here it says assume the credit card payable balance at the end of the 2024 was 301.79. So let's add that information here. So this is a liability. So credit card did indeed have $300 that was owing on it at the beginning of the year. And this would actually impact our equity at the beginning, right? Because this is money that we owe, right? So we would actually need to reduce the equity by that amount, because that way, if we don't do that, right, and our assets equals our, let's just add that up there, 4380. Assets equals liabilities plus owner's equity. So that would be our beginning balance. And going back to the payment itself, so again, the easiest is to worry about the cash goes down. And this would be a reduction of a liability, right? Because you're paying off something you owe, and presumably there would be kind of increases coming in here as well. But we don't have the credit card statement yet, so we won't worry about that quite yet, right? So we have a negative balance. This reduces our liability because we would owe some money on our credit card there. Next one, we have tuition. So payment tuition for the community college. These are the prerequisites required for university down the road. So this is another payment of 2,500. Right. And this is an expense because this is now us paying for, or Jenn paying for her tuition. So this is kind of like tuition expense of 2,500 reduces our owner's equity. We've got the bank charge. So we've got the Bank of Funk $15 bank charge. So cash goes down by $15. Kind of feels expensive for Jenn. So yeah, maybe she needs to look into that or try to get that lowered down the road. But that is another expense. Here we go. We're going to add in $15 there. That one's pretty easy. Okay, then we have rent again. So we have rent again, 19, but you see this is actually February rent. So Jenn was a day early. So the question is, where should this go in January, right? So the cash is pretty straightforward, 1950. But does this make an expense, right? You might be tempted to put this here in expenses, but actually remember we're doing January 2025, and this expense, this rental, is actually would be for the next month, right? So this would create something called a prepaid at the time being, right? Essentially, we've prepaid all of our rent in advance, right? So we kind of have next month, we don't have to pay in February, right? But we shouldn't be expensing this in January, especially if we wanted to in a couple lessons from now, we'll getting more into financial statements. And we don't want to muddy up January's financial statement with an expense that actually belongs in the future month. So we're going to leave this in a prepaid. So that means in next February, we've already kind of paid in advance. That's when the expense could be expected to come in February. Okay, that's good. Next, we have payroll again. So that one we've already seen. That should just be an increase to cash as well as an increase to income, talking about our kind of employment income that we've seen. And we've got two more transactions to go through. So the first one is a $3,000 credit card payment. So another credit card payment. Oh my gosh. Jenn's loaded up the credit card for January. So surely we're going to have to do some further inspection to see what the heck she's spending so much money on her credit card, and maybe take a look to see if there's any opportunities for savings there. So we don't actually know what this is related to, but that is fine in the moment. This would be a payment and a reduction of the credit card payable of $3,000. Okay, last transaction is a HELOC payment. So this is something called a home equity line of credit, kind of like a mortgage or something that you would use to support the rental property or any sort of investment property that you're looking to use, right? So here we have some information. This is the monthly payment at the end of the month. There's an annual interest rate being charged, and also some information about the closing balance of the loan, right? And this is where we'd maybe want to take a moment and add some of this other information in to give us a more full picture of Jenn's situation. So for example, we have an asset, right? This rental property is actually worth, we'll say the fair market value is $650,000 at the end of last year. So that would mean we actually have another asset here, and we'll call this apartment, right? And this would be 650, and we're increasing 650 here, right? The rest of it has to go to equity, right? So we're going to add that in from an equity. Maybe just double check our total cash, or sorry, total assets is equal to, so that's 380. That's good, right? But this would be the scenario if Jenn didn't owe any money on this apartment, right? But actually, that's not the case, because it says right here we've got a closing balance of the loan at the end of last year is this 86,348. So that is a liability, and we can add this into here and increase our liability there, right? So this would actually need to be reduced from the equity, right? We need to subtract, similar to what we did to the credit card. We're going to subtract this HELOC because not all of that apartment is equity. We still owe a decent amount left, 86,000. So now let's just double check. We got the 654. And then, yeah, down there we can see the sum. So that's good. We've added in kind of the opening balances, giving us a more full picture of the opening. Prepaids, we can assume that that would be zero at the beginning. Student loan, maybe there was something else. We'll kind of put a question mark there. And now we have kind of a full opening balance picture of just a small snapshot of where Jenn kind of is. Okay, so tackling our last transaction then, dealing with the cash first, which does complete our cash. So now we can kind of see the ending balance and agree this back to this ending balance here and here. So we can now see like, okay, that checks out. So that's good. But where does the rest of this go, right? It's not that simple, actually. Let's see, we've got an annual interest rate and we've got the closing balance of the loan. So really what we need to do is we have to calculate, because some of this payment is going to reduce the loan, and some of it is going to be interest. So if we calculate some basic interest here, I'll kind of walk you through how I'm calculating this 341. So we'll take the balance of the loan at the end of the year. We'll multiply it by the interest rate of 4.75%, and then we'll divide it by 12 months to get us that kind of monthly proration, right? And since we're not actually making any payment until the very final day, we can assume that this loan was not touched for the entire period, so that this interest expense is thereabouts accurate, right? It might be off by a slightly bit, but I think it's good enough to paint a picture here. So let's say that interest is our expense, and then the rest of it would be going to this HELOC here, right? So this would reduce the loan. There's a interest component and there is a principal component, bringing our overall balance a little bit down. So that completes those transactions. So now what we can do here is start to kind of add things up a little bit. Our investments or our cash, we're confident that that's correct because we can already see the bank statement. And in real life, this is the same. You know what the ending cash balance is, right? Especially nowadays where we're not using physical checks as much anymore. So you can be pretty confident that the ending balance of cash is in fact the correct balance. Investments, there's at least 400, but chances are there's some other amounts baked into this beginning balance that we'll look at sometime in the future. The prepaid, this is for next month's February rent, and then we've got that, fair market value of the apartment sitting there at 650. So Jenn's total assets is sitting at 657,774. We'll do the same thing for liabilities. So, this might look strange to you, negative credit card, but that's because there is some information missing here because we haven't looked at any credit card. We haven't looked at any credit card statements yet, right? We've only cracked open the bank statement. So next class, we'll see how that can further be affected. The HELOC, so the loan itself is decreased slightly. And the student loan is, say, at least 7,500, depending on if there was any beginning balance, which we're not too sure about. That is okay. Equity can stay the same here. And then we add up kind of our income for the month, all of our different sources, and subtract our expenses. So you can see under the current information we have available to us, they're showing almost like a bit of a, if we just do like revenue minus expenses, we have a bit of a net income actually for this period, right? This would be a basic, let's just do equals minus 5235.12. So our kind of mock net income currently is around 2,500 bucks, but again, this might change based off more information we'll get in the future lessons. So this all balances out, which is good. And this kind of, should introduce you to some of the basics of just thinking of it in kind of increases and decreases. We're not worried about debits and credits quite yet. Next class, we'll be thinking about that. And how you can take someone's kind of personal situation and apply these accounting concepts to. I wanted to leave some discussion questions for the end, just to kind of get you thinking about it. Feel free to kind of drop a comment or discuss on what your thoughts are. So why is the credit card liability negative? What is the missing component? We've talked a little bit about that before. What about this? How would the accounting equation be affected if the fair market value of Jenn's investments on the end of the 2024 was 24,000? Let's say this is all held within a tax-free savings account. And what advice would you like to offer to Jenn, right? So there's just kind of some open-ended questions that you can think about into the next one. So the next video will be diving a little bit more into journal entries, and we'll start our discussion on financial statements as well. But hope this video was helpful. Let me know what your thoughts are, and we're going to see you in the next video. Thank you.